Hey guys, Tex here. Thanks for joining me for a early/midweek market analysis video. Doing one a little bit early because there has obviously been some significant developments in the market the past 2 days. On Monday, the Dow dropping over 1,000 points, and today dropping 879 points, it looks like right here. So two significant down days in the market. In this video, I want to go over my investment portfolio here with M1 Finance. We'll see how that fared during the sell-off, what I've done with the portfolio so far. I also will go over my day trading accounts with you. I traded options and futures today, and we'll just talk about the news articles and the technicals and what we could be looking for in the coming days. So without further ado, let's jump into the video. All right, guys, so talking about trading today, I went very easy on the options. Let me bring that over here. You can see I'm finishing up $201 today. Just really taking it easy because of the uncertainty in the market. But I did get a really nice trade in the futures. You can see that I am closing it out here, up $1,005 trading the NASDAQ futures. Now, this was actually a swing trade. I initiated the trade off of this higher low right here, and I was looking for about 9,300 on the trade. I thought we had it in us to really get a nice retrace. As the trade started to work, I put a trailing stop in place, and it ended up getting triggered right here on this pullback. So unfortunately, didn't get 9,300. You can see that was the right call because that was the top, and then we rolled over considerably into today. So just was a little early on that, but still made nice little payday on it. The reward would have been closer to about 3,200 if we got that 9,300 target, but I'm not going to complain, and that is why you use trailing stops, especially with volatility in the market. So that is how the trading turned out. Now, the dividend portfolio here with M1 Finance, if you're not familiar, I did open up initially an account with Robinhood. I still have that account, but its purpose was to originally invest in dividend-paying stocks, but I had decided to switch to M1 Finance in the end because I realized that the amount of time and work that was going to have to go in on my end in terms of actually executing trades and manually balancing the portfolio just wasn't really worth it in order to maintain control of order execution. So with M1 Finance, the way it works is when you put money into the account, they have basically one trade window. If you pay for the plus version of M1, you get a second trade window, and it's 9 a.m. and 2 p.m. and basically any trades are executed during that trade window. So it's more about obviously investing. It's not something you're going to be using for trading. But I gave up that control over order executions for the decreased in workload when it comes to balancing the portfolio and executing orders, because it takes time, especially when you're holding several different stocks. So the way it works is you have basically your portfolio constructed from pies, and within each of those pies, you generally have either individual companies, or you could put like ETFs in there if you wanted to, some type of funds. The way I'm doing it is investing in individual companies. So you can see I am obviously down with the market down. I'm $169.65 in the red, but I have gotten my first dividend payment there for $1.06. And the entire portfolio down 3.93%. So again, basically in each of these pies, I've constructed mine into individual sectors that I'm currently invested in. And along the right side here, you can see the target allocation. So I tried to go pretty much equal weight in all of the sectors, except I went heavier in real estate because it does pay more in dividends, and I went lighter in technology because it was kind of overvalued. Now we're getting into an area where it's getting more attractive, but they also pay less in dividends. So I went a little bit lighter in technology, industrials, and tried to round it out in the middle here. So for example, if I click on any one of these sectors, you'll see the individual companies that I am holding within that sector. And we go back to just another one. Here's healthcare. I'm invested in currently 3 companies there. I just added Pfizer today. But if we go to the holdings page here and we sort by cost basis, so we're putting the heaviest weight companies on the top and the lightest on the bottom, these are the 22 companies that I'm currently invested in. I was previously invested in 20. I added 2 today, which was Target and Pfizer. So I'm going to keep the portfolio relatively small at this point in time in terms of the number of companies, because we are talking about a small portfolio in value. So I don't want to spread my money out too much between too many companies. But as the portfolio portfolio grows, I do plan on adding more companies to get more diversification. Obviously, right now you can see the companies are all big blue chip companies for the most part. So I wanted to start out with those. Generally, they're safer investments, too big to fail, if you will. It's not that they won't go down with the market. Of course they will. But these are all quality companies that pay good dividends. And that's really what the goal of the portfolio is. The dividend yield on the portfolio at this point in time is 3.7%. So it's got a really good dividend yield. But you do want to be cautious when you're dividend investing. It's not about chasing high yield dividends. You also want to be looking for quality companies. So maybe one of these days I'll make a video talking about how I look for companies or what I look for when it comes to picking companies. So like I said, that's the goal of this portfolio, is to just take any extra money that I have after I've paid my bills and I've maxed out my retirement accounts. Of course, keeping just a little bit in savings for a rainy day, if you will. I want to put the rest in this account rather than leaving it in a savings account, because savings pays almost no interest these days and you just lose out to inflation. So jumping into the news on the Wall Street Journal here, talking about Dow Industrials falling more than 750 points. Clearly, we can see that from this graph. The NASDAQ down 8.8%, the S&P down 7.8%. Incredible drop over the past 2 days. And we look at this graph here when it compares this current sell-off to the last big correction we had, which was between September and December of 2018. At that point in time, the market dropped about 20%, but that was over several months that occurred. You can see from the graph, the initial drop was down about 10%, and then we got stuck in kind of a range, and then we broke down below that range and went an equal distance even lower. And that brought us into bear market territory, which is 20%. You can see correction threshold is at 10%. So as of right now, we're very close to a technical correction threshold, but not quite there. However, we are getting into some very technical levels on the S&P 500 that we'll go over here in just a minute that could indicate we might see some type of a relief rally over the coming days. The question is do we just face a dead cat bounce and we get kind of stuck in another volatile range like we did back in August of last year? Or do we continue to see a sell-off after the bounce? Or maybe dip buyers come in aggressively? I think it's all really going to hinge on what happens in China, as we've been discussing in previous videos. That's really what sparked all this. And then you've got the fact that the market was incredibly overvalued, trading way above earnings. And you've got people positioning themselves very, very poorly who are going to panic and start going off. And that's what leads to, a significant pullback like we saw today. This article was a little interesting from CNBC. Basically, this guy is talking about the bond market is indicating a possible entry into stocks. And he's saying that the last time that the earnings yield, the S&P earnings yield and the 10-year U.S. Treasury yield hit its current level was in November of 2016, December of 2018, and May of 2019. All of those times the market getting very extended on a sell-off and rallying off of those levels. So I think what he's talking about here, I would tend to agree with, is that he's saying folks are just running out of the equities and buying bonds at all cost, and he doesn't think that's a smart thing to do, because we've been patiently waiting for a pullback and the market has been overbought for a long time. Now, it is a little bit different with the news out of China for sure. A significant slowing in the global economy could really lead to diminished returns, at least in the short term. But I still think that the long-term picture is intact. I do believe that in the long run, we will probably be okay. The dip will get bought. So we'll see. Well, again, it's all going to hinge on how this major news out of China develops throughout this quarter and really into the next quarter. So that's relatively interesting. Now, from the technical side, we take a look at the SPY here, and very considerable level of support we are approaching. And that is really the top of this megaphone top trend line that I've discussed right here. Now, we're still a little ways from it, but we're very, very close, and that is a significant trend line. It has been validated and proven support. This other trend line is a little bit of a benefit of the doubt. I've attached it to the low here in December of 2018, which was, of course, from that 20% correction, and we anchored it to this low here in October 3rd of 2019. So that trend line technically is not validated, but I do like that you've got these two trend lines, kind of a confluence of trend line support coming in there. And then you've got a little bit further down to that 200 SMA. So we aren't quite down to 10% correction on the SPY, but we're close. We're a lot closer on the NASDAQ. So if we switch over to the triple Qs, there it is. Your 10% correction is coming down to here. Now that is not really support. I just marked that out for reference, but you can see yesterday gapping down well below the 20 SMA. I mentioned in the market analysis video from last Sunday that we'll have to see if we gap down below the 20 or if we hold it as support. We certainly gap down below it. Huge gap that eventually probably will want to get filled, but it's not ready yet, clearly, because yesterday gapping down beneath the uptrend line and above the 50 SMA. So we kind of got stuck right there between resistance and support on the NASDAQ yesterday. However, today came the liquidation break and down we go. So we're just shy of our 10% correction threshold, but very significant level. So perhaps we open with a little bit of a gap down tomorrow. We'll see if we can find some support right here around this 10% correction area. Again, this isn't really a support line, but psychologically it is. A 10% move lower is a psychological level of support. So we'll see what it does. I do believe over the coming days we'll see some type of a bounce, a relief bounce anyways, in a lot of these stocks. I'll be looking for some calls, and we'll see if we can get some type of a retrace at least after we get a little bit of settlement here. So it might not be tomorrow. We might have to have like a little bit of a doji day tomorrow, and then on Thursday we see a significant bounce higher. And then finally, I'll just leave you with, let's look at IWM as well. Sorry about that. Your small caps here, Russell 2000 index. Significant move lower, of course, along with the rest of the market, and notable that it came down into its 200 moving average and closing just underneath of it. So any retrace on the small caps here in the Russell is going to have to hinge on holding that 200 as support. We're below it now, but we could easily gap above it, hold it as support, and rally off of that. Again, just speaking short term at this point in time on the rallies, because there's every indication that we could actually see a dead cat bounce, if you will. So with that, the last thing I'm going to go over here is the VIX. So looking at the VIX here, it did hold that higher low, big expansion in volatility with a gap up and the big push up. However, we can see that it is reaching the top end of the volatility expansion from times in the past. This was back in December of 2018, and we're fast approaching the top end of that range. So I'd say that is also going to be signaling pretty soon that we'll see a decent size retrace here in the market, a little bit of contraction in volatility, and then we will see what happens if the market wants to have another leg down, or if the dip buyers really take control and look at this as a really good buying opportunity in a previously overbought market. So I will wrap it up there, guys. I really appreciate you watching. As always, feel free to leave any comments or questions below, and if you enjoyed the video, please hit that like button. It does help me out. I really do appreciate that. All right, take care, guys. We'll see you in the next one.